Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So the S&P 500 is breaking down below its bullish structure, the bullish price channel that we had since the October low. The index went on a 20% run off that low as investors started to price in inflation coming down, the Federal Reserve tightening cycle potentially coming to its end, and now we're potentially seeing all of that completely get reversed. I believe the breakdown that we're seeing right now is a testament to that we'll be seeing an acceleration of the downtrend ahead of us. So in this video, I'm going to show you why and also how bad things could actually get for the stock market. Keep in mind, these are my opinions. Our conviction on the market stems from the research that we post on gameoftrades.net, where we highlight our entire strategy, our entire outlook on the market, and what the best assets are for the current macro environment. But don't forget that there are some very smart people out there with very different opinions on the market. So explore, learn as much as you can, stay open-minded, and don't forget to smash the like button if you enjoy this video. And of course, subscribe to the channel if you are new here. Now, without further ado, let's get right into it. Okay, so the first chart that I want to show you to give a little bit of context is the equity to money market asset ratio. So what it is the total assets in equity mutual funds and ETFs compared to the total assets in money market funds, which is basically cash. So you can say it's a measure of sentiment in the market and how much people are willing to take risk in the market, how much the financial system is basically leveraged long on equities or not, and how much safety and risk aversion there is in the market right now. You can see that's been coming down throughout 2022, but if we zoom out here, right, you can see we are still at historically elevated levels compared to anything that we've seen throughout history. Now, if I put this on log scale, it perhaps gives you a better picture of what this actually looks like. We really are in that red zone where you do basically have the entire financial system leveraged long on the equity markets. And you can see where equities typically become attractive. It's when you're getting closer to that green zone or you're even below that green zone, because the lower you are in this ratio, the more money on the sidelines actually exists to come into the equity markets and push them higher. That's exactly what happened right here in 1985 when all the money that was stored in cash started to come into the equity markets leading up to the dot-com bubble. But the point is that in real bear markets, this ratio comes down. You see investors take risk off the table, raise their cash positions. That's not something that we've seen even throughout the 2022 bear market, which seemed very intense. It seemed very aggressive to a lot of people. But I think this chart is a testament to the fact that things can get a lot worse from here, that you really shouldn't underestimate the power of the markets to go much further than you thought in either direction. Now, part of what drove this rally here since October has been all about the Fed, right? And this is something that we were highlighting a lot back here, is the fact that the 2-year yield was peaking, that we were likely to see looser monetary policy, a softer tone from the Federal Reserve, because we were getting lower inflation data, we were getting weaker economic data. And so that was basically a sign for the Fed to back off, start to be a little bit more dovish, and the market to get excited. That's exactly what happened. But look at what's happening right now with the 2-year yield, which you can say is a proxy for what the Fed is going to do over the next few months, what their tone is going to look like. It's been rising very aggressively recently, very similar to what we saw actually here in August at the very beginning of this downtrend right here. So monetary tightening expectations are moving higher. They're exceeding the highs that we had in October here. So that's indicating that you really no longer have the Fed behind your back on this rally. Momentum is returning to the upside. The market is again pricing in further rate hikes as we had that very hot labor report right here back in January, showing the lowest unemployment rate since the 1970s, right at the moment where inflation started to skyrocket. So depending on how much momentum this move has, and it seemed like quite a strong move right now, just based off tightening expectations, you could already see a complete retracement of the rally that we had right here. By the way, if you are so far enjoying this video, don't forget to smash the like button. It really helps us out, so it is appreciated. Another big headwind to the market throughout this year is that earnings, S&P 500 earnings, are most likely going to be declining as we do start to head into a recession like 2000, like 2008. That's the signal that we're getting from the bond market telling us we are heading straight into that type of environment. Now, if we look at the current sentiment in the market, you can make the case that sentiment has been quite bearish more recently. But as we discussed at the beginning of the video, that doesn't mean that the financial system can't deleverage from current levels. There's a lot of money that can flow out of ETFs, out of mutual funds, and into cash at current levels in the current market environment. And in fact, I want to show you in 2008 what the bear market rally, the bull trap, looked like right here in May of 2008. And you can see following the top actually in October of 2007, you had a very bearish sentiment right here, very bearish sentiment. And then during the bull trap here in May, you had a brief spike in optimism that marked the exact top of the bull trap. And then the bear market continued. If we fast forward to today, well, we have a very similar setup. We had a very bearish sentiment right here. We had a rally off October, multiple months of the market moving higher. Investor optimism started to pick up. Investor sentiment started to get very optimistic about the market rallying much higher, the bear market being over. That marked the exact top of the run, and now we're breaking down. So these are all things that we've been discussing over the past month here, right? You look at any of our videos right here, we've been discussing the very poor outlook on the economy, on the markets that we see for 2023. A very different take to what we were saying much earlier back in late 2022. We had a much more optimistic take on the market. But over the past couple of months, while the macro was pointing to downside, the S&P 500 itself was in a bullish structure, right? So you also want to respect the trend. You also don't want to fight the trend. Momentum was returning to the market here as shorter moving averages were crossing above longer term moving averages, which is typically what happens as the market is recovering from a bottom. But now we're seeing clear signs that we are breaking back down below the bullish structures as the macro is deteriorating, which significantly impacts how we're looking at the market in the near term. We have positions like Bitcoin that we added at around $19,000. It's currently trading at $23,000. So around a 20-25% move higher since we included it in the model portfolio. But this is a position that we're going to be looking to book profits on as we see a deterioration in the macro environment. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you're interested in that type of service, make sure to click the link down below and get yourself a free trial on our service. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.